Ken, kicking it off with you, with the retail earnings that we're seeing, how do you describe or assess the retail backdrop right now based on what we heard from Lowe's and the companies that, of course, we heard from yesterday, including Walmart?
Right, Maria, if I could just take it back a month to big tech earnings, it sets up almost like we're seeing, parallel the last 24 hours. I mean, the big tech companies, they raised guidance, they beat the top line, they beat the bottom line, they're buying back stock, they do all these wonderful things. Pre-market, all those big techs are higher and it faded throughout the day. Fast forward to yesterday, same thing. You can't ask for a better quarter from Home Depot, from Walmart, a top line beat, a bottom line beat. Raising guidance going forward, buybacks and so forth. And what do? Pre-market were higher, sold off throughout the day. So that's a pickle that we're in, is that we're selling the news. And if you're an investor in these names, big tech or retail, you're really scratching your head frustrated, say, wait a second, these companies hit it out of the park. They're raising guidance. And yet the way the stock's reacting is not the way investors are hoping for, that's for sure.
Well, there's also the fear of inflation, right? So what about that? Sure. You see things like lumber up 100% year to date, the price of corn, lots of food, by the way, chicken. Is this cutting into the growth story that we would have expected? We expected a pretty good bounce, given the fact that the comparisons are very good. Last year, we were in a shutdown.
Right, and look, we're having more demand and so forth. But the inflation, again, we're seeing it, raw materials, so wholesalers get it. They pass it on to the producers pass it on to the consumers, and next thing you get yourself in this vicious cycle. And Maria, honestly, we're probably in the second inning or third inning of a 9-inning contest, so to speak, of inflation. And this little economic terminology, remember this, elasticity of demand? We're really going to have to test that. Elasticity of demand for your viewers means as you raise prices, does demand go up with it? And so you raise prices and demand goes with it. Eventually you raise prices and demand wanes. But since we're in the early stages, these companies are going to be able to pass off a 3%, a 5%, a 6% without really seeing any demand going down. So that's the pickle that we're in right now.
So what would you expect to hear from the Federal Reserve? We are waiting for the minutes from the last Fed meeting. Do you expect any change in language on inflation? Are you concerned that the Federal Reserve is going to see inflation, start talking about it, and cause a sell-off for stocks?
I think the minutes were pretty consistent, because we heard from Fed governors, since the Fed minutes, and they're pretty consistent saying, hey, we think it's transitory. Yeah, we noticed this, but it's only transitory. And you keep on hearing the kind of memo that everybody has walking around with all the Fed governors saying it's transitory. So I guess we're going to hear the Fed minutes that everybody agrees to keep Fed fund rates at zero, unanimous, not to worry about tapering for some time. That's unanimous. And, oh, by the way, we're seeing this little blip in inflation. That's transitory. And that's really where the market's really picking apart and say, is it really going to be transitory? Again, we'll see with the numbers, but that's what the Fed's betting on, that the stimulus that went out directly to consumers was a big surge in the first quarter and part of the second quarter. But then after those direct payments, that things are starting waning. That's what they're hoping for in the so-called transitory inflation.
Well, what do you think the market is down today for, Ken? We got the Dow Industrials down 220 points right now. Is there something out there that you're hearing that is weighing on markets, and where are you finding opportunities? I think you like the ARK ETF, right?
Right. So there are a couple areas that we like, but I think really the earnings, are disappointing. I mean, again, great earnings, but the way they're being reacted to is very disappointing to investors. So we like materials, XLB. Again, they own that's a iShares, and that owns Dow Chemical, DuPont, and those type of names, companies that make something. XLE is energy, and as you mentioned, ARKK, and this is the Wall Street darling up to about middle of February of this year. Kathy Wood's $40 billion ETF, last year up like 150%, has all these innovation type of companies. Companies are disrupting their industries. So you think of like Roku, Square, NVIDIA. These things are hammered. Again, we're tipping a toe into this. We're not getting heavy into it. But at some point, the pendulum swung so far from growth to value. And I think people in value are going to get kind of bored with 2 or 3% top line growth, and money will eventually find its way towards growth. And so we're going to kind of early stages of maybe some of these names that are so hot in February start coming back a bit.
All right, we got a great interview coming out with Michael Kantrowitz from Cornerstone Macro. He's got a list of companies that will benefit from inflation and the companies that you want to avoid in that regard. Ken, we'll be speaking soon. We so appreciate your time this morning. Have a good day.
Thanks, you too.
Ken Mahoney.